I'm just waiting for more people to join. I'm just waiting for more people to join. Okay, let's go through question 1. It says that we're doing fixed assets and the statement of financial position. The information relates to Tanda Limited for the financial year ended 28th February 2025, and 1,800,000 shares were in issue on the 28th of February 2025. And then for question 1.1, it says refer to information B for fixed assets and correction of net profit before tax for the year ended 28th February 2025. And then 1.1.1 says calculate the missing amounts noted by A to D on the fixed asset note. So let's look at that. We're told to look at information B. Okay, let me just zoom in. So this is our extract of the fixed asset note, and these are the missing amounts denoted by A to D. So for the first one, we have the vehicles column. They're looking for A. They're asking and A is the carrying value at the beginning. So they're asking what is the carrying value at the beginning. So to calculate the carrying value at the beginning, we need to take our cost at the beginning minus our accumulated depreciation at the beginning. So that will be 460,000 minus 396,700, which will equal 460,000 minus 396,700. 396,700. So that will give us 63,300. Okay, then we continue. The second one is B. Now it's on the equipment column. They're asking for the disposal at carrying value. Now let's see what other information have they given us on the fixed assets. In point 1, they said fixed assets, the business is having 2 vehicles on 28th February 2025. The second vehicle was purchased on the 1st of November 2024. And then vehicles are depreciated at 15% on cost. Then we go to equipment. We're told equipment was sold for 40,550 on the 1st of October 2024. And then we're told the accumulated depreciation on the equipment sold was 36,000 on 1st March 2024. And equipment is depreciated at 20% per annum on the diminishing balance method. Okay. So now, for this equipment sold, we need to record this disposal at carrying value. And which carrying value is this? It's the carrying value at the date it is sold. So since it's the carrying value on the date that it is sold, we need to calculate the depreciation for the current year. They only gave us depreciation, accumulated depreciation up until the beginning of the year, the 1st of March 2024. We need depreciation up until the date it was sold, which is the 1st of October 2024. So our year starts on the 1st of March. You can draw a timeline if that will help you better. Use that. And it ends on the 28th of February 25. And this was sold on the 1st of October 2024. So we need to calculate the number of months from the beginning of the year up until the date of sale. So that would be March, April, May, June, July, August, September. We don't count October because this was sold on the 1st. So then that means this was depreciating for 7 months in the current year. So now to calculate our depreciation, okay, we were told how much the equipment was sold for, 40,550, and we're also told the accumulated depreciation. Okay. We weren't given the cost of the asset at the beginning of the year that was sold. Okay, let's see what other information we're given. So we do have the carrying value at the beginning of all our equipment, and then we have the cost at the end. So we can take our cost at the end minus our cost at the end. So cost at the beginning minus our cost at the end, because they didn't tell us that we purchased any equipment, just that we sold it. So then if you were doing the T account, let's say for equipment, if you're doing the T account for equipment, you'd have your balance at the beginning, which is the 360,000. Then on the opposite side, you'd have your balance at the end, which is the 285,000. And then there were no purchases of equipment, but you did have an asset disposal, and that's unknown. So then your balance would be 360,000. And then all you do is just take the 285 and subtract it from the 360. So 360,000 minus 285,000. And that will give you an asset disposal of 75,000. So that's our cost at the beginning. Okay, let's continue. Put this there. So now we have our cost at the beginning. We can then calculate our depreciation. So we say 75,000, which is the cost of the asset we disposed of, minus its accumulated depreciation at the beginning of 36,000, multiplied by the depreciation rate of 20%, multiplied by 7 over 12 months. So let's calculate that. 75,000 minus 36,000 multiplied by 20% multiplied by 7 over 12. Okay, so that'll give you a total of 4,550. So that's our, what's this? That's the depreciation for our asset. Okay. Add a page. Okay, so now we have the depreciation for the current year, so we can calculate our total accumulated depreciation. That will be the 36,000 at the beginning of the year, plus the 4,550, we just calculated, which will give us 40,550. Okay, so that's our accumulated depreciation for equipment on the asset that was sold. Now we can calculate the carrying value. So the carrying value will be the cost of 75,000 minus 40,550. And that will give us a total of 34,450. Can we just fix this? 34,450. And that's our answer for B. So A and B have been answered. Then C is depreciation for vehicles. So for vehicles, we were told we have two vehicles. The vehicles we had at the beginning of the year, then there is the second vehicle that was purchased on the 28th of February 2025. Now, let's start with the old vehicle. Old vehicle. So that vehicle's cost was the cost at the beginning, which is 460,000. Calculate depreciation at 15% per annum on cost. So it's just cost times percentage. So that'll be 460,000. 160,000 times 15%. When we had that for the whole year, it wasn't sold. So 69,000. Then for the new vehicle, we first have to calculate the cost. So the cost will be our cost of vehicles at the end, because that includes the old vehicle of 970, and we subtract the old vehicle 460,000, and that will give us the cost of the new vehicle. So 970 minus 460, and that will give us 510. And now that we have 510,000, we'll say 510,000 multiplied by 15%, that's vehicles. And then when did we purchase this? We purchased on the 1st of November 2024, meaning we didn't have it for the full year. So again, you just have to draw a timeline somewhere. And our year starts on the 1st of March 2024 and ends on the 28th of February 2025. Then this was purchased on the 1st of November 2024. So we've had it since November up until February. So that would be November, December, January, February, which gives us 4 months. Then we'll multiply by 4/12 because that's how long it depreciated. So let's count. 510,000 multiplied by 15% multiplied by 4 divided by 12, or 4/12. And that should give you 25,500. So that's a depreciation for the new vehicle. Now there in the question, since we're doing the, we're doing the note, fixed asset note, we need all of the depreciation for vehicles. So we'll add 69,000 plus 25,500. Okay, let's get another page. So depreciation is then for vehicles 25,500 plus 69,000, which is equal to 94,500. Okay, give me a second. Okay, I'm back, but not for a long time. I'll pause the lesson here and then we'll continue later on. Okay, I'm back. So we just calculated depreciation for vehicles, which was C. And now we need to do the last one, which is D. Okay, so for D, it's depreciation for our equipment. So equipment, we have the remaining equipment and we have the sold equipment. So for the sold equipment, we'd already calculated the depreciation to be 4,550. Now I need to calculate for the remaining equipment. So first, the cost of the remaining. So that'll be 360,000, which includes all equipment sold and remaining. Then we subtract the remaining. Oh, wait, we already have the remaining cost. It's 285. Okay, so the remaining cost is 285,000. Okay, so it's the accumulated depreciation at the beginning that we need to calculate for the remaining. So the total was 150,000 and the sold was 36. So we say 150 minus 36, and that will give us 114,000, which is the accumulated depreciation for the remaining equipment. Then we say 285,000 minus 114,000 multiplied by, what was the percentage? 20%. And then had this for the whole year, so we don't need to apportion. Or we can just say times 12 over 12. So 285,000 minus 114,000 multiplied by 20% will give you 34,200. 34,200, and that's our answer for D. So we are done with question 1.1. That's your 14 marks. Okay, let's continue. Okay, so the next question asks us to calculate the profit or loss on the sale of equipment on the 1st of October 2024. Now, to get your profit or loss, you need to take your proceeds, basically what you got for selling your asset, minus the carrying value of that asset. Okay, so we sold it for 40,000. We sold it for 40,550, and our carrying value was, that's our answer to one of the other questions. Let's see, equipment sold. The carrying value was 34,450. 34,450. Okay, so we say 40,550 minus 34,450. That'll give us 6,100. And it's positive, so it's profit on disposal or on sale of fixed assets. Okay. Let's continue. Then it says use the table provided to calculate the correct net profit after tax for the year ended 28th February 2025, plus for an increase and minus for decrease. Okay. So it was calculated before. Okay, I don't have the table with me right now, but let's do this without it. Page, new page. Okay, So we are told in information A that net profit before tax is 1,049,749. It was calculated before correcting adjustment 1 to, what's this, 7? 6. Adjustment 1 to 6. So we need to correct those adjustments or show how those adjustments would affect the net profit before tax. So in that table, you would have your incorrect net profit before tax of 1,049,749. Then we get to our fixed assets. Our fixed assets, we need to calculate, we need to show what would be in the income statement. So in the income statement, the things that would affect the income statement that are around fixed assets, that is the depreciation and the profit on sale. So our depreciation, let's see, we had depreciation on vehicles, we had depreciation on equipment. And now depreciation, what's this? What type of element is it? It's an expense, so it would decrease our net profit. So let's go back and see what were the values for our depreciation. So for vehicles, depreciation was 94,500. And then what was it for equipment? D. Let me just check again. Wait, I didn't add it up. Okay, so for equipment, it's 4,550 plus 34,200. Which is 38,750. Okay, so we'll take that 94,500 plus 38,750 to give us depreciation of 133,250. Okay, and the next thing we have is the profit on sale of fixed assets. So we just calculated that to be 6,100. Okay, the depreciation was a minus, profit is a plus. Okay, brackets for me are minuses. Okay, then we carry on. Number 2 says the account of Loazing Kanyana at data 1,800 must be written off. So that's a bad debt. Bad debt. So we minus 1,800. Then we go to number 3. Number 3 says provision for bad debts must be adjusted to 5% of outstanding debtors. Okay, so we have this bad debt of 1,800 that must be written off. So we'll go to the balance that's given in the trial balance for debtors. So where's debtors? There's trade debtors. So we need to go to trade debtors and subtract 1,800, which is written off. So that will be 751,800 minus 1,800, which will give us 750,000. And then we take that 750,000 and we use that to calculate our provision for bad debts. Now they said we must adjust to 5% of outstanding debtors. So our provision will have a provision for bad debts adjustment. in the trial, not the trial balance, the profit statement. Provision for bad debts, adjustment. We have 750,000 times 5%. And that'll give us provision for bad debts of 37,500. Then we need to see what was the balance for provision for bad debts in the previous year. So in the previous year, provision for bad debts was 40,000. So it went from 40,000 last year to this year to 37,500. So it decreased. Now it's a good thing when provision for bad debts decreases, because that's telling us that we're now expecting less people to run away with our money. We're expecting more people to pay us our money, which is a good thing. So then provision for bad debts adjustment in this case will be a part of our income. It will increase our net profit. If it had done the opposite, it would decrease our profit. So a decrease in provision for bad debts increases profit. It's income. So we'll say 40,000 minus 37,500, which will give us 2,500. Positive, plus. Okay. Then we go to 4. 4 says rent of 158,000 was received from a tenant for the period 1st March 2024 to 30 April 2025. So our year ends on the 28th of February. So anything after that is income received in advance, because we are the ones receiving the income. This amount takes into account reduction of 2,500 per month from the 1st of January 2025. Then they say the year-end adjustment has not yet been taken into account, meaning we have that income received in advance. So we are told here that when we are now removing the income received in advance, we need to take into account that the rent was not the same throughout the year. During the year, we had a reduction of 2,500 from the 1st of January 2025. So again, with these type of questions, timeline is always so important. So our year starts on the 1st of March 2024 and ends on the 28th of February 2025. And we received rent up until the 30th of April 2025. So this is 12 months. And then this is an extra, what's this? 2 months? Yeah, March, April. So we've received rent for 14 months. And then during this 14 months, there was a decrease from the 1st of Jan 2025 of 2,500. And so let me see if I can't use a different color. Okay, so from here. So this is 2 months. This is another 2 months. So for 4 months, we had minus 2,500. And here we had the full amount. Okay, so let's see. What have they given us as our total rent? Rent. I think I need the, what's this? The answer book. Oh yeah, no, they told us it was 158,000. The total rent was 158,000. Okay, so we know we received rent for 14 months. Okay, let's see, 14. Yes, received rent for 14 months. 10. Okay. 10 of those months with the full amount for the minus 2,500. So we're trying to calculate what was the original rent amount. So 10 months plus 4 times M minus 2,500. And let me just write it down here. So it's 10 months plus 4 of those are minus 2,500. So it's 10 months plus 4 months plus 4 times 2,500, which is 10,000. Minus 10,000 will give us 158,000. Okay, so we go to 158,000. We add back the 10,000 that was subtracted for the 4 months that had a reduction, and that will give us 168,000. Then we divide that 168,000 by the total 14 months, and that will give us rent before the decrease, which is 12,000. Okay. I've written a lot, so let me just add another page for that. Okay. Okay. So let me explain that again. So we received rent for 14 months, and of those 14 months, 4 had a reduction of 2,500. Say negative 2,500, which gives us minus 10,000. And then all of this in total gave us 158,000. Now what we want to do, 158,000. So what we now want to do, we want to see what was rent before the reduction. What would our total rent be before the reduction? So we would need to add back the reduction. So we say 158,000 plus 10,000, which will then give us 168,000. Then we say 168,000 divided by the total number of months rent was received, which is 14, and that will give us our rent per month before the reduction, which is 12,000. So now we need to remove the rent received in advance. That was received for an extra 2 months. So we'll say 12,000 minus the reduction times 2. 1,000 minus 2,500. And that'll give us 19,000 as our income received in advance. So that does not belong in the current year, so that means we will need to remove it from our net profit because that is income for the next year. So what do? We say rent minus 19,000. Okay. Then we continue. The next question we have, what do we have? We have the repayments on loan. The repayments on loan are fixed at 40,000 per month, including capitalized interest. Now, what they mean by capitalized interest, they mean that the interest on the loan is added to the loan balance. Then we are told the balances as per loan statement were as follows. This is what we had at the beginning of the year. This is what we had at the end of the year. And then we need to provide for interest on the loan. So this is how the calculation for the end balance works. You start with the balance at the beginning of the year, which is the 4,100,000. Then you add your interest, which is the unknown amount. Then you subtract your payment. So we told it was 40,000 per month. So we just multiply that by 12. 40,000 times 12. And that'll give us your total payments of 480,000. And there are minus, and that'll give you your balance at the end, which is the 3,800,000. Now, we are missing something that's part of the calculation, so we need to go backwards. So what does that mean? For calculating our interest on the loan, we'll start with our balance at the end of the year, which is the 3,800,000. Then we add back the payment of 480,000. Then we subtract our balance at the beginning of 4,100,000. And that will give you our interest on loan, which is 180,000. So number 5, interest on loan. That's an expense. So 180,000. Okay. Something I forgot to say. If you do have questions, you can type them in the chat below. I'll answer in the comments, or I'll answer here if I see a comment. Okay. Let's see. Okay. So now it says, after taking into account the corrections above, it was determined that an additional 91,000 is still owed to SARS in respect of income tax for the year ended 28 February 2025. Okay, so let's see. What have they told us on SARS? So the provisional tax payment was 128,000. So this is what we've already paid for the current year for SARS. 128,000. And then we are told in the adjustment that we still owe 91,000. So that means we paid 128,000. We still owe 128,000. We still owe 91,000. So the total that we owed was 128 plus 91, which gives us 219,000. So that's how much our total income tax is. What are we calculating? Net profit after tax. So this will be income tax that will subtract from the profit before tax. So let's calculate here what our profit before tax is. Net profit before tax. So we started with 1,049,749, right? We subtract 133,250 for depreciation. We add profit of 6,100, and then we subtract bad debts of 1,800. We add provision adjustment of 2,500. We subtract rent of 19,000. We also subtract interest on loan of 180,000. And that should give you a total of 724,299. Net profit before tax equals to 724,299. Now we have our income tax. So we'll say minus 219,000. And so 724,299 minus 219,000 will give us 505,299. So that is 1.1 complete. And then for tomorrow, I'll just complete the next question, which is the statement of